Okay, so when you think of silver, what comes to mind? Probably jewelry, right? Maybe some old coins. But what if the real story of silver today is hidden? Tucked away inside your phone, your car, and even the power grid itself. According to the sources we've been digging into, what's happening with this metal goes way beyond the daily price charts and deep, deep into the mechanics of our modern world.
And this brings us to the big puzzle at the heart of the silver market right now. You see the headlines screaming about record high prices, and you think, wow, the big move must have already happened. But what if that's just the surface story? The sources we've looked at are suggesting the real story, the much bigger one, is something else entirely.
Okay, here's the number that just changes everything. The all-time high for silver wasn't last week, it was way back in 1980. Now, if you adjust that price for, 4 decades of inflation, its real value is closer to $194 in today's money. Think about that. It means silver, even at its recent peak, isn't even halfway to its true inflation-adjusted record.
So how on earth can a metal be hitting records and still be so far from its actual peak at the very same time? Well, to solve this paradox, the sources point to a number that most casual observers completely miss. Think of it as a kind of secret handshake for serious analysts. And that secret handshake? It's what's known as the gold to silver ratio. Now, this isn't some super complex formula cooked up in a lab. Nope. It's a simple but really powerful market signal that analysts used to get a sense of the true value of silver. So how does it work? It's actually dead simple. It just measures how many ounces of silver it takes to buy 1 single ounce of gold. A high number means silver is cheap compared to gold. A low number means it's expensive. It's like a historical yardstick that helps the pros cut right through all the day-to-day noise.
So what's this yardstick telling us right now? Well, if you look way back through history, the average was about 15 ounces of silver to 1 of gold. In more modern times, a pretty conservative average is closer to 40 to 1. But today, even after silver's recent run-up, the ratio is still hovering around 60 to 1. For analysts, that's a flashing red light, a huge signal that silver is still significantly undervalued compared to its historical relationship with gold.
And you know what? The market is starting to pay attention. According to the sources, when the ratio recently broke below its previous highs, it wasn't just some random blip on a chart. For the people who watch this stuff closely, it was a major trend shift. It was that quiet alarm bell going off, signaling that a fundamental repricing might just be getting started. But listen, historical ratios, they're only half the story. The core argument from the sources goes way beyond finance and right onto the factory floor. It's about a simple but profound fact. Unlike gold, which is mostly just stored, silver gets used. It actually gets consumed.
Yeah, while gold sits pretty in a vault somewhere, silver is out there working. As you can see, over 60% of all silver demand now comes from these critical industries. We're talking solar panels, electric vehicles, and the massive data centers that power AI. Sectors where silver's unique properties make it literally irreplaceable. There's no substitute.
And this right here might be the single most important idea to get your head around. Silver is mined, it goes into a factory, and then it gets permanently locked into the backbone of our modern economy. It is consumed, it's used up, and it's gone forever. This isn't money sitting in a vault. It's a critical component inside your world.
So you have this relentless, non-negotiable industrial demand for a metal that gets used up and just disappears. And that demand is now colliding head-on with the stark, cold realities of global supply.
On one side, you have demand from the green energy and tech revolutions that's just accelerating. On the other side, you have a supply that's incredibly rigid. Inelastic is the technical term, but all it really means is you can't just flip a switch and get more silver. Most of it is a byproduct of mining for other metals like copper and lead. And after years of underinvestment, there just aren't enough new mines ready to fill that gap.
And the result of this collision? A structural supply deficit. It's simple math. For years now, the world has been consuming way more silver than it mines. The projection for 2026 alone is a staggering shortfall of 67 million ounces.
And this isn't some new problem. 2026 is on track to be the 6th straight year of this deficit. So you might be asking, where's all the extra silver coming from? Well, it's being pulled from the world's above-ground stockpiles. Think of it as the global savings account for silver. And that's a solution that, by definition, can't last forever.
So we have this massive supply and demand imbalance building up. To understand what could happen next, the sources tell us to look to the past.
Because while today's situation is unique, history has a funny habit of leaving clues.
Look, silver has had these massive price spikes before. We all know about the famous one in 1980 and then again in 2011, but the sources are crystal clear on this point. Today's driver is fundamentally different from anything we have ever seen before.
Those previous rallies, they were largely driven by financial speculation, paper trading. Today's demand is different. It's physical. It's driven by actual factories that have contracts to fill and products to build. This is demand that couldn't care less about market sentiment. It just needs the metal to operate.
So the final takeaway from all these sources isn't really about predicting some exact price. It's about understanding a massive structural shift, one that's being driven by inflation, by industrial necessity, and by a supply deficit that just keeps getting deeper. A shift they believe is already well underway. The only question they leave us with is not if the market will react, but when.